Sure. First, just a quick comment. 0.15 M by end of year is very conservative, but I think you have to use what the analysts are providing. But my question is, the preferred shares, they have a BTC / credit rating ranging somewhere between 3 to 9 or 5 to 9. How effective are those preferred at generating yield, assuming we have periods of crab market? Like, it seems after a 1.25x increase in Bitcoin price, you might have to wait some time before you buy again. And in what conditions would you increase that or relax it a bit to go above 9 or above 10?
If one of the interesting things is right now, you can see from all of our credit models, the credit is all undervalued. Like the marketplace doesn't appreciate the credit very much. So over the next 36 months, you would think that the drivers of our credit strategy will be education of the market. Just getting out and talking to people and educating them on our credit models is a big plus. Every time we do an IPO, you've noticed the first IPO was a little bit smaller than this or more difficult than the second. The second was easier. The third was double that. The fourth was more than double that. So every time we go back to the market, we educate more people. We're educating credit rating agencies, and as the world's view of Bitcoin as collateral evolves, that makes it easier. So as a general trend, the direction of travel is the world is getting more comfortable with Bitcoin-backed credit, and that makes our strategy easier. Let's assume that Bitcoin chops sideways. The negative is that the collateral value doesn't go up, but the positive is if you actually look at the trailing 30-day BTC vol, it's low. It was like 20 the other day. So when the market chops sideways, the volatility of Bitcoin falls. And you can see one of the most important drivers, in Black-Scholes and the important driver in our risk models is volatility. So we're kind of winning when Bitcoin is surging up because we've got a lot of collateral and a high BTC rating, but we're also winning. If you go and you play with our model and you crank vol from 40 to 35 to 30, and I just showed you an example, if it falls 10 points, stuff that looks like it's high yield becomes investment grade. And so I think our credit strategy might benefit from Bitcoin trading sideways for a while in a counterintuitive way. And for the most part, we're really competing against a bunch of people that don't know. Like the Wall Street Journal is running an ad, high yield savings accounts. You can get 3.6% interest from such and such bank, and there's a world of people that are, by the way, if SOFR falls, if the Fed, changes policy, those banks will be yielding 2%. Your bank account will be 2 or 1.5%. We're out there educating the retail market that there's something better than that. And I think that our credit strategy right now is primarily driven by educating institutional buyers, educating retail buyers, educating credit rating agencies, and having the world embrace Bitcoin as good collateral. And at the point that JP Morgan and somebody else starts to accept it's good collateral, then I think people come back and look at our credit and they re-rate it and they say, oh, actually it doesn't deserve a 600 basis point credit spread. It should be a 200 basis point credit spread. So I think that all of those dynamics actually overwhelm whatever the price action is of Bitcoin in the next 24 months to 36 months. Any of you other guys have something to add?
Heads you win, tails you win.
I think the important point is when Bitcoin is highly volatile, it's very good for our equity. And when Bitcoin, people go, aha, what happens when Bitcoin's not volatile? And what they don't realize is if you take that credit model I showed you and you crank in 20 vol and all of a sudden we fall to 20 or 25 vol, you can go to 90% leverage. Because the credit looks like investment grade at 90% leverage. Bearing in mind, by the way, that banks that are issuing preferred stocks we compete against, they're 20x levered. Right? They have $20 of a liability for every dollar of equity, and they're paying 5% or 6% yield, and we're offering 9%, and we're not. So really, this all comes down to educating the 20th century market about why this Bitcoin-backed credit is better, and that's a fundamental thing that overwhelms, I think, the near-term volatility or lack of volatility or price change in BTC itself.
All right. Thank you.
Thank you so